So today I want to talk to you about corporate-owned life insurance and the capital dividend account. The CDA account, of course, is an account that is only available to Canadian-controlled private corporations. So it's not a public organization, and it has to be Canadian-controlled. In other words, 51% of the shareholders have to be residents of Canada, basically owners in Canada. So therefore, it is really only available to private organizations, private companies and everything else that are, like I said, Canadian-controlled private corporations. Okay. Now, the CDA account is not really a real bank account. Okay. There's no, you don't go into a private corporation and say, I'm going to see your CDA account. It doesn't really exist. That's why I say it's a notional account. So it's sort of fictional or phantom account, another way of looking at it. So it doesn't actually sort of hold any funds itself, okay? There's no actual bank account. But it simply is, it tracks or keeps a running balance of any funds that are owed to the shareholder, okay? So basically it's just an accounting entry, really. And it keeps a track, you might say, of that capital dividend. That money, remember, that capital dividend is owed to the shareholders. So it keeps track of all that. So for example, just two examples, there could be some other kinds of income as well, but generally speaking, it holds 50% of the tax-free capital gain. Okay, so if the company disposed of property, whatever it is, shares, whatever, so any of the, as you know, the inclusion rate is 50%. So 50% of the inclusion rate, which is tax-free, will go into the CDA account. Also, it would also hold the death benefit of any life insurance policy that the corporation may own on its key person or shareholder or whatever it is, okay? And that's what we need to talk about here is say, okay, is it the entire death benefit that goes to the CDA account? And the answer is no. The answer really is that it will be the amount of money, the life insurance money proceeds that will go into the account will be the proceeds itself minus the adjusted cost base. Okay, the adjusted cost base. And for our purposes today, really, all we need to look at is that the adjusted cost base is the premium that's been paid all these years. So here we've got Bill. He's a shareholder of Acme Incorporated. Okay, the company owns a life insurance policy of $200,000 on his life. The company is also the beneficiary of the policy, and the premium paid by the company is $3,000 a year. Okay, so basically the company owns everything, pays the premium, the whole bit. So Bill is basically simply the life insured. Okay, Tom dies 10 years later. Okay, so 10 years into the contract, he passes away. The proceeds of the CDA will be, of course, the life insurance policy, which is $200,000 in this example, minus the adjusted cost base. And for our purposes today, the adjusted cost base is simply the premium paid, okay? This will, of course, be calculated exactly by the insurance company and all that sort of stuff there. But for our purposes today, just know that what goes into the CDA is the insurance proceeds minus the adjusted cost base. So for simplicity's sake, let's assume the adjusted cost base was $30,000. So of that $200,000, $30,000 does not go into the CDA account. What goes into the CDA account is $170,000. And that $170,000 now can be distributed to the shareholders basically tax-free. So the CDA account is really a tax-free account. That can, so dividends can be, that's why they call it a capital dividend, not an income dividend. Okay, it's a capital dividend. And so therefore, being a capital dividend, basically can be distributed to its shareholders to tax-free, basically. Okay. So you might say, so well, what about the $30,000? What happens to the $30,000? Remember that the $30,000 was paid by the company from its general account. So basically, that $30,000 is refunded to the general account. So the money does go into the insurance company, except the money is split. So the premium goes back to where it came from, which is generally speaking the general account of the insurance company, and the capital dividend portion of that, in other words, the difference here in this example, $170,000, that goes into the CDA account, and that, as I said, is tracked accordingly. And that money could sit there for years and years if that's what they want, or that money could be taken out by the shareholders. All they need to do is basically declare a special dividend to the shareholders. So usually a lawyer will be contacted to declare a dividend, a capital dividend to to the shareholders. And that at that point, then monies can be distributed because it's all recorded accordingly according to the rules and everything else. So it's not an issue. Okay. So basically, what happens is that even though only one check actually arrives at the doorstep, it is split. Okay, it is split, and basically 30,000 will go into the general account. 170,000 will go to the CDA account. The lawyer then says, okay, the board of directors are meeting, and we will declare $170,000 capital dividend account to so-and-so shareholder. Money gets paid out, and that's the end of the situation. So as I said, what's really important to remember about the CDA account is that it is only available on Canadian-controlled private corporations, not on public corporations or corporations that are foreign-owned. They basically, even though they may be private, but they're foreign-owned, that will not apply. It has to be Canadian-controlled private corporations.